I do want to start off with the hiring that we've seen in state and local governments. We know it was depressed for a while because of the pandemic. We've returned to pre-pandemic levels, at least in aggregate here. But of course, this is still dependent on economic conditions and, more importantly, the health of the balance sheets of these municipalities.
Yeah, you're correct. We have seen some gains in the state and local government sector, and they've come back to a more normal level to where they were slower to respond relative to the rest of the economy. So if we look at kind of the overall health of the balance sheet for state and local governments, we don't have too many concerns with credit quality for most municipalities. In fact, over the past 15 quarters, there have actually been more credit rating upgrades relative to downgrades. So currently, the state of the muni market, if you look at the average municipality, the average issuer, about 7 out of 10 of those are either AAA rated or AA rated. So the backdrop right now for credit quality for municipalities appears relatively favorable. So we don't have too many major concerns right now, Romain.
Do you feel that those municipalities have the discipline to hold that line? Because we've already seen a couple of them sort of squander the gains that they made coming out of the pandemic.
Yeah, so you're obviously going to get divergences. The muni market's $4.4 trillion large in terms of the size of the issuers outstanding. So there's a large market. You're going to get divergences. So there are going to be pockets of risks. But overall, we don't necessarily think that there are major risks that we're seeing. So a lot of the pandemic aid, like you said, it did go a long way to kind of cover up a lot of warts. But also what we saw is that we saw a surge in tax revenues, and many state and local governments actually used those revenues to build up their rainy day funds. So a rainy day fund is akin to like a savings account for you and I. So some states have had to start to tap into that to help smooth revenues. But given the size of those rainy day funds, that can go a long way to smoothing any sort of credit concerns.
School districts that got pandemic aid did not use that money for rainy day funds. They spent it immediately on teachers, on administrators, on services for students. And that aid is going to end soon. And those school districts will have to make some hard decisions on whether they cut those services or whether perhaps they need to borrow money to keep some of that going. Do you anticipate a wave of issuances from school districts in the coming months and years?
Yeah, that's a very good question, because year to date, we've actually seen a very big surge in issuance. Going into the election, my expectation is that we'll probably see a decline in issuance. Also, it's very important to look at what is backing a specific municipality. So for many local governments, which are school districts, those are backed by property taxes. Property values have been increasing on a year-to-date value. If you look at the Case-Shiller index, it's up about 4%. So again, that backdrop looks relatively favorable, but I wouldn't be too surprised on the issuance side of things if we do see a little bit of an increase in issuance next year. But shorter term, it's probably likely to slow a little bit.
Okay, talk a little bit about what continued rate cuts from the Federal Reserve later this year, at least 25 basis points in November, December, would mean for issuance in 2025.
Yeah, so we would expect that that would go through and see lower borrowing costs, and therefore probably a little bit of an increase in issuance. I think also what's important with the Fed rate cuts is that we know that rate cuts are coming. So we can debate between if is it going to be 25 basis points, 50 basis points, how's the non-farm payroll going to influence that tomorrow? But overall, our expectation is that we're going to get 2 25 basis point rate cuts and then continued rate cuts into next year. So our house view is 4 rate cuts of 25 basis points, so a total of 100 basis points next year. I would expect if we do see lower borrowing costs, then that should also be a sign of increased issuance.
And then this gets back to the other issue, though, too. And I have to ask you about with the big election coming. And I know the focus has all been, of course, on the presidential race, but we kind of forget, you still got a House race with hundreds of seats up for grabs here, and not to mention, governor's races, et cetera, here. Any chance that that could reshape your outlook for munis into 2025?
I think when you look at politics and kind of the outcome of the election through the eyes of the municipal bond market, how I'm looking at it is, are there going to be changes to tax policy? So we know that municipal bonds issue a tax exempt interest or pay interest that's generally tax exempt. So if there is a change in that tax policy, that's where I think that could influence things. Now, we're also suggesting that it's way too early to make changes in your portfolio based off of what's been discussed on the campaign trail. So I think looking forward, though, the 2017 Tax Cuts and Jobs Act are set to to expire. So how does that change? What does that look like going forward? And that's really going to be influenced by the makeup of Congress as well as the makeup of the president. So I think that there's a lot of dominoes that could fall between now and what actually happens with the tax laws and tax policies, that it's just way too early to really shift things in your portfolio.